This is the average rate of inflation now, or how much you will lose every year if you keep money in your bank account. This is the average return from the US stock market. And this is the average return from the Indian stock market. Means if you invest 50,000 now in the Indian stock market, your money will double in around 3 years. So if you are an Indian living in a foreign country who is losing your hard-earned money to inflation by keeping it in a bank account, then this video is for you. I will show you how you can make use of this once-in-a-lifetime opportunity to build wealth. Before we start, I'm not a financial advisor. I'm just sharing information based on my knowledge and my experience. Having said that, let's get started. I said once in a lifetime opportunity, and I wasn't joking. According to a paper published by Morgan Stanley, India is on track to become the world's third largest economy by 2027, overtaking both Japan and Germany. There are many factors that are currently in India's favor, such as the highest population of young working people, strong domestic demand, and a strengthening financial sector. There has never been a better time to invest in India. But then, it's not as straightforward as an NRI compared to an Indian citizen living in India. NRI or non-resident Indian, in simple terms, is an Indian citizen or a person of Indian origin who has spent more than 183 days abroad in the last financial year. And before an NRI can invest in India, one crucial step has to be completed. Set up a bank account. There are two types of bank account that an NRI can open in India. An NRE account and an NRO account. And the main factor that decides which one to open is repatriation. And repatriation is, in simple words, the ability to send money back to the country where it came from. The money in a non-resident external or NRE account is totally repatriable. But then you can only deposit money from abroad, and it gets converted and credited in Indian rupees. Later, you can freely convert them back to foreign currency and transfer funds back to your country of residence anytime. And since you have already paid income tax to the foreign government for the money you transfer to an NRE account, these funds and the interest are completely tax-free. On the other hand, an NRO or a non-resident ordinary account works on a non-repatriation basis. The funds here cannot be transferred back to the NRI's country of residence or converted to foreign currency. Technically, it's possible, but the process is more complicated and has limits. This is best suited for those having income sources in India, such as a rental property, pension, dividends, etc. However, the funds in an NRO account and the interest you accrue are taxed according to the normal income tax rates. But then, a crucial prerequisite to open a bank account is to do the KYC. This is a way for the banks to ensure that the clients are who they claim to be. To complete KYC and open an account, you must fill out an application form and submit copies of your PAN card, passport, foreign and Indian address proof, and passport size photos. All documents must be self-attested and also attested by a recognized authority. Once you submit the form along with all the necessary documents and open a bank account, then we can start investing. But then, where should we invest? This is one of the safest investment options out there. We put a fixed amount of money in an account for a fixed period and then earn interest for that deposit. The normal interest rates for fixed deposits in India is around 5%. But those who want more returns with low risk should consider investing in bonds. Bonds are considered a more secure investment option where companies or state borrow money from you. Ideally, you act as a bank providing a loan to the state or the company and get interest in return. The risk here is that the state or the company could go bankrupt. Since it is highly unlikely that the Indian government will go bankrupt anytime soon, government bonds are one of the safest investment options out there for risk-averse investors. And the returns are not that bad. For example, the GOI savings bond have a 7.75% return. You can buy bonds through banks, dealers, or directly from the Reserve Bank of India website. To buy bonds, besides a bank account, you will also need a demat account, which I will explain shortly. Keep in mind that when you buy bonds from the state or the companies, always check for the credit rating. The higher the rating, the safer the investment. But if what you are after is maximum returns for your investment, then nothing can beat what I am going to tell you next. Stocks are stakes in a company, and by owning a company's stock, you technically own a piece of the company. And as the company grows, so does the value of your stock. You make profits when you sell them at a higher price than you bought. And the places where they are sold and bought are the stock exchanges. India's main stock exchanges are the National Stock Exchange NSE and the Bombay Stock Exchange BSE. Companies list their stocks on the exchanges and are classified based on the market capitalization, or simply the company's worth. Large cap stocks are the stocks of the top 100 companies. Mid cap between 101 to 250, and from 251 onwards, all are small cap stocks. And for large cap stocks, you can get an average return of 10 to 12%, mid cap 14 to 16%, and for small cap 16 to 20%. Small cap stocks grow the fastest because these are the small companies with the highest growth potential. But there is also the risk that the company may not exist after a few years. Larger the company, more stable it is, but lesser growth. When we talk about stock market, we also have to talk about market indexes. An index is a collection of stocks that are grouped together based on size or industry. The most common indexes in India are Nifty and Sensex. Nifty is a collection of top 50 companies listed on the NSE. Sensex is similarly an index of the top 30 companies listed on the BSE. The index goes up when the stock price of major companies on the exchange goes up, and vice versa. So it gives an overall indication on the performance of the stock market. But then we cannot directly walk into the NSE or BSE and buy shares. And for that, there are investment brokers. And the major ones in India are Zerodha, Grow, ICICI Direct, etc. Once we register with a broker, the next thing we need is a trading account to purchase and sell shares. And the shares bought are stored in electronic format in a digital locker called the Demat account, which is linked to your NRI or NRO bank account. If it seems complicated, don't worry. Once you register with a broker, they will do everything for you. A trading account is the one through which we must place a buy or sell order. And this request is then forwarded to the stock exchanges. And once the trade is completed, the securities are deposited in the Demat account and the required amount is deducted from the linked bank account. This procedure is same for NRIs and Indian citizens living in India. But then NRIs need an additional step called the Portfolio Investment Scheme to buy and sell shares. But before we check what a PIS scheme is, we need to understand what's a primary market and a secondary market. The primary market is where the new shares and bonds are offered to the public for the first time. If a company wants to enter the stock market, they do it through an initial public offering or IPO in the primary market. Later, when buying or selling a share, we are not buying from the company directly. We are buying it from others who are willing to sell their shares in the secondary market, also known commonly as stock exchanges. If NRIs want to buy and sell shares in the secondary market, then they would need a PIS account which is linked to the trading and Demat account. The main purpose of this PIS account is to bring transparency to the Reserve Bank of India about the origin of these funds. So once you fill and submit the PIS form with the bank, they will forward it to RBI, and later we will receive a PIS permission letter from the RBI that allow us to buy and sell shares in the secondary market. Banks have to regularly inform RBI about all the transactions that we make with our PIS account. And the banks, they charge a fee for this. But then we don't need a PIS account when we buy directly from the primary market or invest only in mutual funds. A fund is a collective investment where money is pooled from many people and then invested together in the stock market. This is a great option for diversifying your investment across different sectors and reducing the risk associated with individual ones. These funds are managed by fund managers who assess the various investment options and decide where to invest. This means less work for you and more work for the fund manager. However, nothing in life comes for free, and we have to pay the price for the effort the fund manager puts to manage our investment. This is called the expense ratio of the fund, which is typically around 0.5 to 1%. The best way to invest in mutual funds in India is through a systematic investment plan or SIP. Here, we invest a fixed amount of money regularly in a mutual fund scheme. For example, I currently invest with a SIP in a multi-cap fund from Canara Robeco. Money is divided and invested between small cap, medium cap and large cap companies. But since most of the investment goes into medium and small cap companies, these are very high risk investments. But I am in a stage of life where I can take a bit more risk for higher returns. But the investment that made me the highest returns in the last 5 years was a ULIP. Unit-linked insurance plans or ULIPs are one of the ideal options for investors who want to invest for the long term and also want a backup. They are a hybrid product which combines the advantages of investing and life insurance into a single package. Here, we pay a premium for a fixed number of years and then get the money along with all the profits after the maturity period. Part of the premium goes towards insurance coverage and the rest is used to invest in financial instruments such as mutual funds of our choice. I invested in a Platinum Plus plan from Canara HDFC 5 years ago with an insurance policy and the money nearly doubled. So although there are enough opportunities for an NRI to invest in India, there are also some restrictions. As an NRI, your total investment in a company cannot exceed 10% of the total company's capital. I don't think that would be the case for most of us. Also, NRIs are not allowed to do intraday trading, also known as day trading. This is when stocks are bought for lower price in the morning and sold for higher prices in the evening. I am not into trading and I'm always looking for long term when it comes to my investments. So this doesn't make any difference for me. But something that can make a difference is taxes. NRIs are supposed to pay capital gains tax similar to resident investors. This is a tax we must pay for the profit or gains that we make through selling our investment. If we sell our investments within a year, then we have to pay a short-term capital gain tax of 15%, and for the investments held for more than 1 year, a long-term capital gain tax of 10%. However, long-term capital gains up to 1 lakh from equity investments are exempted from tax. I hope this video gave you a starting point to begin your investment journey in the Indian stock market. But know that every investment involves some kind of risk. So do your research and choose wisely before you invest your hard-earned money. If you have any questions related to this, then you can write to me in the comment section below. I will try to answer them as best as I can. And if you want to support me and my channel, then give the video a like and click on the subscribe button. That would mean a lot. Until I see you with another video, have a wonderful rest of the day and adios.